Thanks so much for coming. My name is Lindsey Mignano. Again, I'm the co-founder of SSM, which is a women-owned corporate law firm. We're small but mighty here in the Bay Area. Most of our clients are pre-seed through Series B. I'm talking about the state of venture capital today. We're going to be dropping a lot of stats. Every quarter, our firm goes through researching a number of things, CBS insights, Carta data, PitchBook, et cetera. And we try to distill this data for our clients so that we can become better lawyers. For the most part, like I mentioned before, our firm is very heavily focused on venture financing, M&A, and tech transactions. It is the reason why we tend to speak a lot on venture capital. One of the things that I wanted to broach and kind of open up the conversation on was the different stages of financing. And this can be very different in different parts of the world and in different states. We have a lot of clients here at SSM that are from Europe or Canada or other places, and where the stages of financing, the numbers could look very different here. But here in the Bay Area, where most of our staff live and where most of our clients are, I broke it down here as pre-seed, seed versus series seed, and then of course going into the multiple rounds here. So pre-seed I define as generally anything that's 500,000 or less. It's usually a Y Combinator safe note round. 3 out of 4 notes these days are safe notes. Usually the post-money valuation cap safe is the most common. Every once in a while when you're in an industry like life sciences, biopharma, therapeutics, et cetera, you might see convertible notes, or in deals with investors from the South or the Midwest. Aside from the coast, you might see more convertible notes, but statistically, we're seeing 3 out of 4 notes be Y Combinator safe notes, and the majority of those becoming post-money valuation cap safes. So pre-seed includes anything from like family investing in your company, friends, institutional early stage VC that might cut checks from like 150 to 250, usually likely via safes. There might be some accelerators in there who might give you like 130, 120. It's something that most of our clients go through, and they usually use notes for that. What's great about notes is they're pretty DIY. As long as you know, for example, in the Y Combinator post-money safe note, the valuation cap, the name of your investor, their address, and maybe a discount if you wanted to add one, it's pretty easy to fill out and get that money in right away. So for the most part, we see that here on the coasts. Then we have what's called seed or series seed. And I kind of largely define this as anywhere from like 1 to 5 million. There is a sweet spot around 2 to 3 million where you see startups start doing what's called a priced round, where they're selling shares for dollars as opposed to doing Y Combinator safe notes or convertible notes. And that is usually, again, the 2 to 3 million tipping point. We've seen more. We have some founders who are taking like 5 million on safes. We call them jumbo safe rounds. But for the most part, that's the kind of the tipping point where founder dilution becomes more of a concern. So we see that there. We're also seeing, and historically have seen, multiple rounds of seed. So not just like one round of seed, but seed 1, seed 2. I like to call them maybe avocado seeds, especially if they're larger seed rounds. And of course, during this time, we do see some founder debt or founder classification of investments into their own companies as founder safes. So that, I would say, would be the typical seed round. There's some contribution in some way by founders. There might be some early stage VC, and then there's the same players that are in the pre-seed round, angels, hopefully accredited investors, which for those of you who may not know means that you're liquid 1 million, so outside of your primary residence, or if you're married, you earn 300K the past couple of years, you have a reasonable expectation of doing that in the next foreseeable future. If you're an individual, you make 200K past couple of years and going forward. So ideally, we advise our clients to take from accredited investors if they can. Of course, you can take from an unaccredited investor, but we generally try to err on the side of caution. Now, Series A, B, C, these numbers are somewhat flexible. We just finished helping a company raise a 35 million Series B, so it all kind of depends, but I generally say Series A starts at 10 million in a good market, Series B 20 million, Series C 30 plus. These are kind of round numbers. There's no hard and fast rule. It's very industry and vertical specific, and it depends a lot on, who you're raising from, where you're raising from, and what industry you're raising in. So one of the questions that commonly comes up with our clients is, again, who to talk to, especially if they've never raised a round before. So who to talk to, why to talk to, how to structure those conversations, who to talk to first versus last. Accredited angel investors, maybe angel syndicates comes in first. Usually those are like funds that take a bunch of angel investors who are hopefully all accredited, who have proof of accreditation, and they pool their funds together in a fund of fund structure to invest in a startup. It could be an RUV or an SPV, very commonly. Otherwise, it's individual investors who might be cutting in checks from anywhere from, I would say, 30 to 50K from an individual, maybe more if it's from a family trust. We do have, a strong number of very wealthy real estate here in the Bay Area investors who are angels. And I will say, of my clients who take money from people who are not in tech, who don't understand the J curve, who don't understand the life cycle of an early stage tech company, just to beware of who you're taking your money from. Not all money is good money. Money sometimes comes with expectations on profitability at a stage that you're not expected to be profitable as a tech company. So we do normally have that conversation with our clients to make sure they're targeting the right types of people, right? People who are accredited, people who generally invest in technology companies, who understand that if you're an early stage technology company, it could be 10, 15 years before you have an exit or an IPO, and so in the best case scenario. And so we have that conversation generally and pretty often with our clients. And then of course, there's VC, right? And who is VC? What does that mean? There's so many different types of VC. Our clients generally don't understand at the inception of their raise exactly all the different types of VC you could be talking to. Some of them talk with family offices. That means like a very wealthy family, for example, who takes all their money and pools it into one fund. Daniel Lurie's fund was called Wilmot Venture, for example. Like that's an example of a family office. They tend to be much more flexible in terms of what they invest in. I've seen them invest in anything from like technology companies to theater companies. It's really kind of just dictated by that one family's desire to deploy their capital. So I do tend to see them be more flexible in terms of vertical, stage, as well as founder location. Most times 80% of the Bay Area dollars from venture firms, like traditional venture funds and firms, tends to circulate within the Bay Area. I've found family offices that invest in our clients to be a little bit more flexible in terms of the location of the company. So there's family offices, there's VC firms, and those are the ones that you normally would hear about. They're a firm of people who are venture capitalists. The lower level staff might be called analyst. Then there's like principal and partner. Those are the ones that most people understand. There's also corporate venture capital, corporate strategy, corporate development, and those are essentially VCs that are in big companies like Google or Microsoft or Meta, who take that money of that company and deploy it to companies that are smaller that they might want to acquire, or they just want to fund for their own investment purposes. Sometimes it can be agnostic, which means they fund all different kinds of industries, all different kinds of sizes. Sometimes it's very, very, very specific. And sometimes there's multiple ones. So understanding the landscape of VC is always really helpful just as a founder to understand where you're going. Most of our early stage founders target traditional venture firms. Some of them target if they have a very strong partnership and their goal is to be acquired after Series A or Series B, they might target corporate strategy. And we have had a number of clients that have gotten their Series A investments, for example, from CVC, right? So there are some working knowledge that you would have to have as a startup founder in terms of VC firms, and that's the middle bucket right there. Most of you are familiar with them. I like to tell my clients to look into when do they invest, right? Because a lot of times people will be like, I want to go to that huge fund, which has so many funds, and they have some early stage and they have predominantly late stage funds. And they don't really invest in your vertical or your stage very frequently. And it's really a matter of, what is that appropriate, right? And then there's tons of like emerging funds or by emerging managers, which are usually smaller. A lot of them are run by women and minorities. In fact, that's a very applicable stat. And they tend to invest at pre-seed, so small checks, 100, 200 here. They're not necessarily following you all up the chain and doing your Series B. They might not be able to afford it, depending on the fund size. And they offer a different value prop, right? Because when we see our clients get different funding from different types of VCs, we find statistically that when we have a pre-seed fund that only deploys to enterprise AI software, they tend to have some specialized connections and knowledge and partnership value there. versus an agnostic fund that has so many different types of funds. They deploy all across the stage. They deploy agnostically. Depending on the partner, we may not see our clients get as much attention. Not to say that it doesn't exist, and my husband was at one of those before he retired, but we find that the earlier stage the investor, in terms of the size of the fund being smaller and the team being smaller, they tend to be more active with our clients in terms of participation in really meaningful ways, like developing partnerships, especially for enterprise SaaS. There is an optics issue here, and Peter Walker actually broached it on one of his webinars, and I really do think if you haven't, if you're not following Peter Walker, please do. He's at Carta, he's a statistician, he's a friend of mine. He does great work. But there is an optics issue here, which is if you are targeting a little fund and they, invest in your pre-seed and your seed and maybe your Series A, they follow on and they continue down the line, but they stop after a while, it could be explained by the fact that they're just a small fund. They can't continue to invest. They don't have that much money in their fund. If you get the behemoth fund and they invest in your pre-seed or your seed, but they won't follow on to Series A when they have tons of money to deploy, then really we're seeing kind of an optics problem in the same way that you would see an optics problem if, for example, your lead investor from Series A didn't follow on or lead in Series B, right? So there are some optics considerations here in terms of who you choose to lead your seed, and I figured most of the crowd here might be seed stage companies, so I'm targeting towards that. If there are any later stage companies, feel free to raise your hands. I can kind of give you a more of that flavor, but in terms of the vibe in the room, I think I'm going to try to focus on early stage. So stages of financing, who to talk to, how to raise. So we, as lawyers, tend to be very stats-based lawyers in terms of that we research at our firm. It's a mandate that you know what the current stats are, because not that every client is a stat, but if your lawyer can't tell you whether your valuation cap is 25% lower than the median or the average, and point that out to you, it can be very detrimental to your business. So I would tell all my clients to please review the quarterly data. It's free. You can go to all these websites, PitchBook, Carta, NVCA, sign up for all their newsletters, get it emailed to you. You don't have to pay anything. They'll ask you to, though. They ask me to every quarter. But for the most part, it's free. And you can see what the valuation caps are, what people are raising, how they're raising, whether the market's good or not. And it influences what you might ask for and what might just be off the table, right? So in a harder time like this, when you're seeing less funding go out the door and then less frequently, knowing that difference between 2021 and 2024 is crucial in terms of knowing what to negotiate, what to push back on, especially if you're nearing the end of your rope, right? We had a lot of founders who raised a lot of money in 2021, maybe didn't elect venture debt or other lines of alternative credit, and all of a sudden we're seeing a little bit of a pinch 3 years later. Normally they would go to market for Series B, say at 2 years, but we're finding that being extended 2.5, maybe 3 years. Repeat founders are always still in a better position, especially in markets like these. And of course, location does matter. I dropped the stat about 80% of the Bay Area financing traditionally going to Bay Area companies due to Stanford and Cal. That does make a difference. And there are certainly stats showing that the Bay Area deployment can be anywhere from, like, say, $13 to $17 billion a quarter, right? That's much more than, say, New York at 3.5 to 5.5, or Boston at the same, LA maybe 1 or 2 billion. So it does really matter where you're located. And we saw venture firms be less cognizant of location when people were truly in the pandemic, when everything was on Zoom. And we're seeing, in 2024, more of a push for in-person, more of a push for founders that they can actually reach and grab coffee and talk with about metrics, which is to the detriment of our foreign founders, right, who are not living and working here. So we're seeing that anecdotally. In terms of location, in terms of vertical, obviously there are different places where different verticals really shine. Bay Area does really great for enterprise SaaS, so does Seattle along with gaming. Boston does great for pharmaceuticals, med tech, biotech, life sciences. New York does great historically for fintech. Enterprise SaaS also being really big there as well. So kind of knowing what your vertical is, what your stage is, and where the money is being deployed is always really helpful for early stage founders, especially, and you'll see in a later slide, when you know how many of those dollars or what percentage of those dollars goes to early stage. And then of course, this traction stickiness aspect has become more important in 2021. We've seen more VCs demand that our founders, when they're coming to market for a raise, and a raise of a certain desired size, they're gonna ask them for some level of ARR, annual recurring revenue. Usually if you're a B2B enterprise SaaS software company, you have an annual subscription, maybe your clients pay monthly or quarterly, but it's the usual model. And we have had VCs say that they would actually love it, and this is hard to do, but you can try, so that your customer, your big tech, big co customer that you're licensing your software to, pays on day one for the entire year as opposed to monthly to avoid a collections risk, right? But they are requiring some ARR. Some of them are, and I would say if you're raising a $1 to $3 million series seed round or a seed round, maybe 500 to $1 million ARR. If you're doing a 10 million Series A round, anywhere from 1 to 4 with the sweet spot at 2 to 3 in ARR. And that's for, I would say, enterprise software specific models. If we're talking life sciences or something else, it could be not even a relevant factor. But for most of you here who are probably enterprise SaaS, AI, business to business, that's what we're seeing. The other thing that we've heard VCs say, and not to you, but maybe to us, because lawyers tend to refer to VCs, our clients who are looking to get raised, is team, right? So founders who are maybe 2 to 3 people team tend, in our docket at least, and that's hundreds of startups across of our 20-person team, they tend to get funding faster rather than just one guy. It's not to say it's impossible, and I hope, you know, for all of our solo founders it is, because CTO equity is expensive if you're the CEO only. But we do see that. We do see 2 to 3 founders, you know, being a sweet spot for being primed for venture capital. Ideally, and sometimes VCs will request that they have worked together before. In terms of solo founders, we usually have a solo founder who might be the CEO or business person. We usually will see a VC tell them to get a CTO, an actual person to be a co-founder. Founder followed is real, it's expensive. It makes up 1/3 of our business at our firm because early stage, there's a lot of players in the mix, and there's a lot of dancing, and a lot of engagements, and a lot of broken marriages. So choose carefully. That is something that we always tell our clients. You'd be surprised how many of them go through multiple co-founders, which is absolutely discoverable in due diligence, so be careful. It does say something about you if you're running through like 7 co-founders. Product market fit, earlier stage than ever before. Everyone knows what product market fit is. We're seeing that being demanded earlier rather than later, at later stages. Then I heard an interesting tidbit where a VC on a panel that I was on said they really want to see founder market fit. So not just product market fit, but why you, why now? Why would you be the person, the founder, to bring this to market? And I thought that was really, really insightful, because it does come up quite a bit in terms of the clients that we have that get funded versus the ones that do not. So of course, as I mentioned before, these are the kind of stats that we tend to look at as a firm every quarter whenever they come out. It informs the way that we talk with you guys. It informs our expectations about what we might be able to negotiate or not. This is the CB Insights Q4 2024 Venture Report. They come out with them quarterly, very similar to NBCA Pitch Book. I like this because it tends to show a global perspective. Now, I omitted the global data, but if you can tell, it's not good, it's down. So we're not seeing quite the rebound that I think people had hoped for since 2021. 2021 being the banner year when everyone was getting money. You could just have a napkin idea, no company formed, and some guy was like, I'll give you $3 million. It is not that time anymore, people. The vibe is very different. The vibe is, I am a VC, and instead of cutting 10 $300,000 pre-seed checks, I'm gonna cut that one check to that one guy who already has ARR and is a repeat founder. And so that's kind of more of what we're seeing anecdotally. It does match with the data that I'll show you in subsequent slides. The bright spot is AI. I did a TechCrunch presentation in 2022, and I think the stat then was something like 33, and I've seen anything from 25% to as high as 37, right? So this is great for people who are here, who are in AI enterprise software. That is something that is the bright spot, I think, of our clients, and we have many in generative, some in agents. They are more likely than the other clients who are in, like, for example, retail tech or CPG to get funded in this economy, just because of the hotspot for AI. Now, again, I mentioned Silicon Valley. This is the data here for CB Insights. You can tell the very big difference between 36.6 billion and 4.9 billion and 3.4 billion. And so it really does matter where you are. It also matters how much of that went to early stage, right? Of that percentage, I've put the stats here, just presuming this would be an early stage audience, which I generally say is pre-seed through Series A, B, 70% in the Bay Area went to early stage companies of this amount. We also look at PitchBook. PitchBook's a great resource. They will try to get you to buy a subscription. You can still download their reports for free. This is their Q4 2024 Venture Monitor. Still no recovery. This is not a surprise to anybody. The vibe in the room feels very similar to the stat. But again, just highlighting the AI and machine learning deal activity and deal count. You're still seeing very good numbers for AI, right? Globally, and then just regionally. I would say, though, that the caveat is if you actually look at the total size of the amount of money that went to AI, they're really predominantly to these really big deals, right? So you're seeing a lot of really, really big deals like scoop up a lot of that money. So it's a little bit, if you just look at the stat when you're looking at deal value, you're thinking, oh wow, a lot of early stage companies that must be getting funded a lot. No, that's not true. It's really a later stage AI play in this current market. Carta does great data as well. I pulled the Q3 2024, and I'm comparing it with the H2 2024 data that just came out in January, early January. We're not seeing much of a difference here, but I did want to highlight what I thought was really interesting, which is the data between non-AI versus AI, both from a round size perspective and a pre-money valuation perspective at the 50th percentile. That's really, really interesting to me, that the differentiation there. And I also wanted to show you, I guess for the Q3 2024 report, just the median round sizes. We're still seeing a pretty good median here. I would call a healthy Bay Area Series A market anything above 10 million, and we're still seeing a median of 11.3, 10.3 on a bridge, right? So I think it's looking good. And for those of you who may not know what on a bridge means, it's a colloquial term. It usually means you raised your price round, shoot, you didn't raise quite enough. You didn't elect all the alternative forms of non-dilutive capital financing, or dilutive, you didn't, elect venture debt. And you have to bridge now. You have to bridge to your next round, and you might do that by a convertible note or a Y Combinator safe note. Most of our clients choose either at this point, and right now in this economy, a lot of them are getting forced to take on debt, which is a convertible note because a Y Combinator safe note is not debt. So on the bridge just means the medium round size is on the bridge after the primary round. So lastly, I wanted to talk about things you may not ask your lawyer because we're expensive. We talk and then you get a bill and you're like, oh my God, Lindsey, Jesus. So some of the things that come up most frequently is what our most successful clients do. And because we're lawyers, we can't tell you what one client did that you should do. It's just attorney-client privilege. It's one of those things. But largely speaking, our most successful clients, and again, across 20 lawyers, you have hundreds of clients, so we kind of distilled it on Slack as to what we thought were the best ones, right? The ones who are doing the best. And I think this one comes to me most often, which is they understand the business of VC, and they're actually a venture fundable business, which you would assume that most are. But as lawyers, we get a lot of calls from startups who want to be something, and they don't really understand what kind of metrics a VC needs to show its LPs in order to make its money. And they don't understand how they fit into that model, right? So if I'm a VC and I'm collecting from an LP and I want to show a 3 to 5 times return, maybe your business is not really, maybe you're profitable and maybe you'll sell, right, at Series B, but maybe you're not a unicorn and maybe I need those unicorns to make sure that I can return to my LPs that 3 to 5 times X, right? So clients who understand the business of VC and who actually understand why they're not just a profitable small business. And that is no slight to profitable small businesses. I own one. My family owned one for years. We had 4 generations of a poultry farm in Hawaii. Profitable small businesses are fantastic, and you usually don't give any equity away. So it's not to slight that. I think in the Bay Area, though, there is a strong push for venture capital funding which may or may not be the worst or best decision of your life, because it is incredibly expensive capital, and you may not be the type of business that actually is going to become a unicorn, or you don't have a desire to become a unicorn, and it might not be the fit for the particular business of VC. So while we talk a lot about venture capital, because most of the lawyers here are, in our world we call them ECVC lawyers, emerging companies venture capital lawyers, it comes with a caveat, right? Is whether or not you really are appropriate for it. And then, of course, I love this. These are kind of like two behavioral things, and I work with enough. I didn't go to GSB, but because so many of our clients did, we get a lot of GSB slang terms, which is fantastic. The first one I love, which I use actually pretty frequently, is bean counting. So the founders that we know that are most successful understand when they're able to differentiate between $500,000 struggles and $5,000 struggles. And an example is, for example, and this is just a legal example, and it comes up often in my world, you wouldn't be surprised, but I'm gonna be, as a founder, learning how to do my own securities exemptions. And that takes me 8 hours, but it takes my lawyer 15 minutes. Is that the best use of your time? Shouldn't you be going to market and scaling your product and making ARR so you can get your funding? That, I think, is really one thing that we see repetitively across our founders who may not be as successful. It's the bean counting, it's the attention to detail on everything, which may not be the most profitable use of your time, right? And I gave an example of bean counting, but it's the $5,000, $500,000 differentiation that we see become a pattern that is hard to break. And then, of course, there's anchoring bias, right? So we have founders who are very committed to breaking out their product or their services or their hybrid product and service in this market at that vertical. And they just cannot get away from it. They just cannot break from it. This is their plan. This is what they went to business school for, and they just cannot pivot emotionally. And that is a problem. That and the understanding of what's a $5,000 problem versus a $500,000 problem is something that our founders who may not be able to raise struggle with the most. In the pandemic, and then, of course, after 2021, we had a lot of funding, but after 2021, going to 2022, we saw less funding come out, and we saw more founders. This is the second to last bottom point. We saw more founders being asked to do founder-led sales, and that was because we had a great year in 2021, and then we saw a pullback in 2022 on venture funding, a pullback in 2023, and founders had to let people go, right? So instead of having sales teams with a VP of sales that they pulled from some big tech company, now this guy has to figure out how to go to market on his own. And what we have found is that the founders that are able to suggest to their, and actually make what they consider a process on how to scale their company and get the relevant ARR for a raise, if they can take that, distill it, and make it repeatable, then it works. If it's a founder who can only do it himself, it doesn't work. So we spend quite a bit of time going over commercial contracts for people. And a lot of times with the founders who just got that contract and that relationship because it is personal in some way, it's hard to scale. But if there is a founder who can distill the process and teach it to a team, especially when there is more funding available, we find that they do better. And of course, last but not least, and this is, I think, goes for everything, how you treat everybody, but I mentioned earlier that reputation does matter in this business as founders. You can divorce 7 co-founders, absolutely, you can absolutely do that, and legally we will help you do that. There will be an NDA in your separation agreements, but they are very applicable and discoverable on your books and records of your company when you're paying law firms $50,000 here, $80,000 here, and then settlements of $120,000 here, $300,000 here. It is something that I think a lot of founders believe is, I can do whatever I want, no one will know, there's an NDA. But it does show up. It does show up. And people do, during due diligence, lawyers do see that. We can tell if we're investor side, we can tell if there's a bunch of settlements with employees, and they're all women, or co-founders, and you went through a string of them in 5 years, whether or not you might be a difficult person to work with, right? It is still something that comes up. It's something that we see because we're human. So I would say, how do you treat your co-founders, your business partners, your staff, your vendors? Just because you pay them doesn't mean they have to like them, or they have to like you, and just because you sign a non-compete or a non-disparagement doesn't mean that people follow it. So something to consider. And I would say, I think that's the most important one as we move forward in terms of what I think I would love everyone to take home is reputation. This Bay Area is very, very small. People do talk irrespective of NDAs. And so that is something that I think that would be the best lesson learned. Thanks so much.